Hey everyone, in this video, we're taking you on a thrilling ride through the wild era where people became millionaires overnight, and maybe learn how you could too if an opportunity like this presents itself again. Grab your popcorn, sit back, and let's dive into this mind-blowing chapter of internet history, the dot-com bubble. Our story begins in 1993 with the release of Mosaic, one of the first web browsers. This, along with subsequent browsers, opened up the World Wide Web to the masses. Internet usage skyrocketed, bridging the digital divide and revolutionizing how we connect, learn, and do business. Between 1990 and 1997, the percentage of US households owning computers jumped from 15% to 35%. Computers went from being a luxury to a necessity, marking the dawn of the information age. This shift led to the birth of many new tech companies. At the same time, lower interest rates made capital more available. The Taxpayer Relief Act of 1997 lowered the top marginal capital gains tax, encouraging speculative investments. Alan Greenspan, then chair of the Federal Reserve, reportedly fueled the stock market with his optimistic spin on stock valuations. The Telecommunications Act of 1996 promised new technologies, and everyone wanted a piece of the action. These factors led to a frenzy of investment in any dot-com company, regardless of valuation. Raising venture capital became easy. Investment banks, profiting from IPOs, fueled speculation and encouraged tech investments. Stock prices in the tech sector soared, and traditional metrics like the price-earnings ratio were often ignored. Between 1995 and 2000, the Nasdaq Composite Index rose a staggering 400%. In 1999, Qualcomm's shares skyrocketed by 2,119%, with several other companies seeing similar gains. Despite the Nasdaq's impressive rise, more stocks fell in value than rose, as investors shifted focus to high-growth tech stocks. Personal investing hit unprecedented levels, with stories of people quitting their jobs to trade stocks becoming common. The media played along, treating the stock market like a high-stakes game. Promising dot-com companies could go public and raise substantial funds, even without profits or significant revenue. Employees with stock options became instant paper millionaires, although they often couldn't sell their shares immediately due to lockup periods. Most dot-com companies incurred net operating losses, spending heavily on advertising and promotions to build market share quickly. Their mottos were, "Get big fast" and "Get large or get lost." They offered services for free or at a discount, hoping to charge profitable rates later. This led to lavish spending on business facilities and luxury vacations for employees, often celebrating new product launches with extravagant dot-com parties. As the 2000s approached, tech spending was volatile due to Y2K concerns, which turned out to be minimal, thanks to adequate preparation. Marketing spending reached new heights, with dot-com companies buying numerous Super Bowl ad spots. On January 10, 2000, America Online announced a record-breaking merger with Time Warner. Then, on January 30th, dot-com companies dominated Super Bowl ad slots. Meanwhile, Alan Greenspan's interest rate hikes were seen as a potential bubble-bursting trigger. On March 10, 2000, the Nasdaq Composite peaked at 5,048.62. Soon after, Japan's recession news triggered a global sell-off, hitting tech stocks hard. Yahoo and eBay's failed merger talks caused the Nasdaq to drop, while the S&P 500 rose as investors shifted to established stocks. On March 20th, Barron's warned of imminent bankruptcies for internet companies, leading to a major investor rethink. MicroStrategy's revenue restatement announcement caused its stock to plummet by 62% in one day. On April 3rd, Judge Thomas Penfield Jackson ruled against Microsoft in an antitrust case, causing a significant drop in tech stocks. Bloomberg News emphasized the importance of paying attention to financial numbers. By April 14th, the Nasdaq Composite fell 9%, ending a week with a 25% drop. By June, dot-com companies reevaluated their spending. Pets.com, despite backing from Amazon, shut down in November 2000, just 9 months after its IPO. By then, most internet stocks had dropped 75% from their highs. The September 11 attacks further accelerated the market drop. Investor confidence was shattered by scandals like Enron, WorldCom, and Adelphia Communications. By the end of 2002, $5 trillion in market capitalization had been lost. with the Nasdaq 100 dropping 78%. With venture capital drying up, the focus shifted to burn rates, how fast companies spent their existing capital. Many dot-com companies liquidated, while supporting industries scaled back operations. However, 48% of dot-com companies survived through 2004, albeit with lower valuations. Executives like Bernard Ebbers, Jeffrey Skilling, and Kenneth Lay faced fraud charges for misusing shareholders' money. The SEC imposed large fines on firms like Citigroup and Merrill Lynch for misleading investors. Retail investors, having suffered losses, moved to more cautious investment strategies, and popular internet forums like Silicon Investor and Yahoo Finance saw significant declines in use. The dot-com bubble was a wild ride that reshaped the internet and investment landscapes forever. If you enjoyed this video, give it a thumbs up, share it with your friends, and don't forget to subscribe for more fascinating stories from the world of tech and finance. Thanks for watching, and I'll see you in the next video.